Hi, this is Jack Schwager. In this video, we will take a close look at the trend weight indicator and how it can be used to generate buy and sell signals in the market. Now, the first thing we have to specify is a threshold level for the trend weight. The threshold level is at the point which you will get a buy or sell signal. The default value is 20, and that's what we have plotted here. So these dashed lines are at plus 20 and minus 20. And when the trend weight, indicated by the red line, goes above plus 20, you essentially have a buy. And when it goes below 20, you have a sell. If the trend weight is in between those two levels, you would be neutral, as we'll see in subsequent slides. Now, I've colored the charts here to show whether we're long, short, or neutral. So when it's sort of reddish, that means the trend weight is indicating a short position. When it's green, it's indicating a long position, and yellow, it's neutral. Now, you don't have to use 20 as the threshold. If you define the threshold at 0, let's say, you would be long whenever you're above the 0 line and short below the 0 line. And you could also use higher thresholds, which would require a stronger or weaker trend indicator to give you a signal. The best way to get a feel for how the trend weight works over time is to take a look at one market over a course of a number of years, and a market that includes both bull phases, bear phases, and sideways environments, and see how the trend indicator operates. So we begin here with corn 5 years ago, and as you can see, we begin by this first breakout coming from a short position. We get above the 20 level, we go long, and we basically get a quite nice ride here for this entire up move. And the trend indicator stays well above the threshold levels, even as this market has occasional corrections. Now, you will see these blue lines on some of these charts. I've placed this when we go from one chart to the other, so you know where we got out on the next slide. So essentially, this particular trade exits on the next slide at this level. And that's important because you will notice that the scale will change from chart to chart because TradeShark adjusts to use all the space available. And therefore, in this particular case, you have a price range of about $4 in corn. If we go to the next year in the sequence, you can see the axis here. We only have a little over a $2 range. So these price swings, which seem very large, are not quite as large as they appear relative to the first chart because the scale covers a much narrower range. In any case, as I said, here's where we basically get out when we go neutral, which is basically crossing below the plus 20 level. And we get a short trade, a long trade, and a short trade. These trades basically ranging from small losses to small wins, a little bit of an edge to the small losses, and then going neutral. So one thing I would like to point out is that this is a period where you have a lot of choppiness in the market. You don't have a lot of trades, which is good, and you don't have any really large gains or losses for that matter, but you end up with a small loss, which is not bad considering the choppiness of the market. Next, we go to the next year where we have a couple of other short-lived trades here, and finally get one longer trade where we capture this good portion of this uptrend here. This one gain here pretty much will more than offset the small losses you will have had on these trades in this area. Then we go into a sell mode as the indicator goes below minus 20. So that gets us into the sell mode. And the blue line here is indicating where we will be exiting the trade on the next slide. Now we hit a year where basically the trend indicator is in negative territory the whole time, except for these two short-lived periods where it pops up into the neutral range, never goes long. So during this entire big downtrend here, and given that the threshold that we're using, we don't have a completely unbroken capture of the entire downtrend, but we are only short, and we capture a good part of it, except for the two short intervals where it's neutral. We then go into a neutral phase, get above 20, again long, This is where we exit on the next chart. So we have another small gain to follow on the next chart. And finally, we get to this last year here. This is the where we exit that trade at a small gain. We go neutral as the trend indicator goes below the plus 20, and then we go short as the trend indicator goes below minus 20. Once again, we capture a good portion of this downtrend. At this point, the rebound is enough to get the trend indicator to minus 20 and to get us neutral, and then you essentially get a buy signal and a couple of short-lived sell signals. These trades are all pretty close to break even. So during this period, we're either neutral or when we're long or short, ending up with trades with not much net change. So overall, not bad for a sideways market. So the takeaways here, the way this trend weight indicator tends to work is when you do have good trends, as you could see, it does a reasonably good job of capturing significant portions of those trends without getting whipsawed out of them on the corrections. When you have choppy markets, no question about it, usually you'll end up with a net loss, but the losses are controlled because of several factors. First, you have neutral periods, and second, the longs and shorts tend to be short-lived, and the losses relative to the types of gains you get in trends tend to be considerably smaller. So anyway, that's how the trend weight indicator operates, and hope this walkthrough of 5 years of the market gives you a feel for the trend weight indicator and how it can be used in trading. Next, let's take a look at how changing the threshold level changes the trend weight signals. So we compare two situations in this chart, these pair charts. On the top chart, we're taking a threshold level of 0, meaning that if you get above the 0 line, you have a buy, below the 0 line, you get a sell. And in the bottom chart, we have a fairly restrictive condition where you need to get above plus 80 to get a buy and below minus 80 to get a sell. So let's see how those differences in the threshold levels change the signal. So I'm taking a situation where we have two levels that are on opposite sides of the example we just looked, which was using a threshold of 20. Now we're looking at a threshold of 0 compared to a threshold of 80. So we begin here on the threshold 0 case. You can see there's a blue line. This blue line matches up to where the trend threshold level of 80 triggers a neutral signal. So you get out relatively close to the top here. You get out very quickly. Certainly in this case, getting a better exit than you get if you were using the trend weight of 0. However, as we go on here, you can see that we have a blue line here. We're in a neutral zone with the trend weight threshold at 80, but that corresponds to the point where we go short with the trend in the indicator threshold being at 0. So this one is this case is going short much more quickly than we do here. In this case, where we have the 80, you don't get down below minus 80 until this point. So you're getting a slower entry. In this case, also a poorer entry than you would have had with the threshold of 0. Now we follow this along. We stay bearish actually in both cases. Now the market begins to move up a little bit. Doesn't take much of an up move, and the trend weight gets above minus 80. That's enough to, in this threshold case, to get us neutral for quite a bit of time. If you look here, you get another blue line. This blue line corresponds to the point where the threshold level 0 switches from short to long. So it exits its short with more delay and not as a good point, but it gets long here. The case of the trend indicator threshold at being 80, you don't get long until this point. So essentially, the takeaways you should get from this is the higher your threshold, the longer or more restrictive it will be to get buy and sell signals, but also the more sensitive the system will be in getting out of the trade. So you'll be getting out closer to tops and bottoms, but you'll be getting in more slowly. And the other big difference is that with the higher threshold levels, you have big neutral periods, which you don't get, say, in a narrow threshold, or in this case, a 0 threshold, where you're only 0 when you're at dead 0 in the indicator. Which is better? Well, it's no absolute. It really depends. In some cases, one will be better. In some cases, others. The other will be better. There's no magic level you should choose. Overall, higher thresholds probably have a higher probability, a better return to risk on a per trade basis, but that's not an absolute statement. It really does depend on a particular market. And here's an example of how you as a trader need to pick the approach that you are comfortable with. You can look at how the different thresholds work in different markets and go with whatever type of threshold level makes sense to you. In the next video, video 3, we'll take a closer look at the overbought oversold indicator.